Listen very carefully, because what I am about to explain can decide whether your retirement years feel financially secure. I am not being dramatic, because real market data clearly shows that many retirees are standing on unstable ground. I review business trends, financial reports, and market cycles every day, and the patterns I see right now should concern anyone approaching retirement age. This is not speculation or fear-based commentary, but a data-driven reality that too many people ignore until their financial options disappear. Before I explain the 3 safest exchange-traded funds retirees should consider, I need you to take one simple but important action right now. Subscribe to this channel and turn on notifications, because the purpose here is protecting wealth, creating steady income, and helping people. If you truly care about long-term financial stability, you need consistent access to practical information instead of hype, speculation, and risky shortcuts. The guidance shared here can genuinely help protect your retirement savings, so make sure you stay connected as we discuss what is really happening in today's markets. I regularly meet hardworking people who followed traditional advice, saved diligently, invested responsibly. These individuals did everything they were told to do correctly, yet remain anxious because the market feels unpredictable and unforgiving at this stage of life. They watch their balances rise briefly and then fall sharply, creating emotional stress that steals peace during years meant for comfort and enjoyment. Living with constant financial anxiety defeats the entire purpose of retirement, especially after decades of disciplined effort and personal sacrifice. Here is a hard truth that many professionals avoid stating clearly. Most retirees are not truly prepared for a major market crash. Many portfolios remain filled with aggressive investments designed for growth, not preservation, exposing retirees to volatility they can no longer afford. Others sit heavily in cash, believing it is safe, while inflation quietly destroys purchasing power year after year without mercy. Every one of these approaches carries serious risks that can permanently damage retirement security when markets decline sharply. What truly keeps me concerned is knowing millions of people are just one market correction away from being forced to work far longer than planned. That situation is tragic, unnecessary, and entirely avoidable with the right strategy and realistic expectations about retirement investing. Here is something that may surprise you. Retirement is not the time to be aggressive, speculative, or adventurous with money you cannot replace. When you are young, time allows recovery from mistakes, volatility, and even bad investment decisions that eventually correct themselves. You can take risks earlier in life because income continues, contributions grow, and long-term compounding works in your favor. In retirement, however, withdrawals begin, time becomes limited, and losses hurt far more because new capital is no longer added consistently. You need your money to support daily living, protect dignity, and maintain lifestyle, not remain trapped waiting decades for recovery. That is why retirement investing must focus on 2 priorities working together: safety of principal and dependable, consistent cash flow. You cannot protect your future by hiding money completely, nor can you chase high yields without understanding the risks behind them. A proper retirement plan preserves capital while generating income that can realistically support life expenses through good markets and bad. The exchange-traded funds I am about to discuss are not exciting, trendy, or designed to produce overnight wealth through speculation. They will not double your money quickly or attract attention on social media, and that is exactly why they work so well. That peace of mind is far more valuable than chasing unrealistic returns, especially when retirement income supports daily living. Exchange-traded funds are especially useful for retirees because they provide instant diversification across hundreds or thousands of investments. Instead of relying on one company's success, ETFs spread risk broadly, reducing the damage any single failure can cause. ETFs are also liquid, meaning you can buy or sell them easily during market hours without complex transactions. Another major advantage is cost, because ETFs usually have much lower fees than traditional mutual funds. Fees matter enormously in retirement because every dollar lost to expenses is a dollar not producing income. Unfortunately, many people assume all ETFs are similar, even though thousands of poorly designed funds exist. Some ETFs take excessive risk, others concentrate too heavily in narrow sectors, and many quietly drain returns through high expenses. Certain products benefit fund companies more than investors, offering complexity without meaningful retirement advantages. Because retirement mistakes are expensive and irreversible, I spent extensive time evaluating performance, income reliability, and structural quality. I examined how funds behave during crashes, reviewed dividend history, studied expense ratios, and analyzed underlying holdings carefully. When retirement money is involved, even one poor decision can erase years of disciplined saving. It is essential to understand that retirement investing is not about getting rich, but staying secure. Trying to build extreme wealth during retirement often increases the risk of devastating losses at the worst possible time. True financial freedom comes from confidence, consistency, and knowing your income can support your life comfortably. Market crashes are inevitable, and history proves they occur far more frequently than people emotionally expect. When portfolios drop sharply, fear pushes many retirees to sell at the worst possible moment. However, with the right ETFs in place, panic becomes unnecessary because income continues and diversification provides protection. I have lived through multiple market crashes and witnessed both destruction and stability, depending entirely on preparation. Those who planned properly felt limited impact, while others suffered deeply because their portfolios lacked protection. Preparation must happen before markets fall, just as insurance is purchased before disaster strikes. The first ETF category I want to discuss focuses on dividend aristocrats, companies that have increased dividends for at least 25 consecutive years. That track record shows strength through recessions, crises, and economic shocks, while continuing to reward shareholders. These companies represent discipline, resilience, and operational excellence, making them ideal for retirement income.
This ETF includes businesses providing essential products and services people rely on regardless of economic conditions.
Consumers continue buying household goods, healthcare products, and basic necessities even during recessions. That reliability allows these companies to produce steady cash flow year after year. Owning them through an ETF provides. This dividend-focused ETF typically yields between 2 and 3%, offering dependable income. More importantly, during market crashes, these companies historically decline less and recover faster than the overall market. The expense ratio of this ETF remains low, allowing investors to keep more income. High fees quietly destroy protecting income while minimizing costs is essential, and ETFs accomplish this efficiently. Now let us move to the second ETF. Many people dismiss bonds as boring, but boring becomes valuable when stability matters most. This bond ETF focuses on short-term bonds, reduce volatility, and handle interest rate changes far better than long-term bonds. They generate income while these bonds are issued by highly creditworthy institutions, minimizing default risk. The goal of this ETF is protect. When stocks fall, high-quality bonds often remain stable or increase in value. This relationship cushions portfolio declines during market stress. Bonds act as shock absorbers, reducing volatility and preventing forced stock sales. This ETF typically yields its expense ratio is extremely low, making it highly efficient. Buying individual bonds is complex, while ETFs provide simplicity and scale. In retirement, simplicity reduces mistakes and emotional decision-making. This bond ETF plays a critical role in protecting income and stability. Now let us discuss the third exchange-traded fund, which is designed to bring balance, simplicity, and structure together for retirees. This third fund is a conservative, balanced ETF that combines both stocks and bonds within a single investment, creating automatic diversification across asset classes. Think of it as a complete retirement solution for individuals who prefer clarity, structure, and consistency instead of managing multiple investments separately. These balanced ETFs typically allocate around 40% to stocks and 6% to bonds, although some maintain a more even 50-50 structure. The stock portion provides modest growth and dividend income, while the bond portion delivers stability and protection during periods of market volatility. This combination allows retirees to participate in market growth without experiencing the extreme ups and downs associated with stock-heavy portfolios. For retirees who do not want to rebalance frequently or make constant adjustments, this type of ETF offers a practical and stress-free solution. One of the most valuable features of balanced ETFs is automatic rebalancing, which helps maintain the intended allocation without emotional decision-making. When stock markets rise significantly, the fund naturally reduces equity exposure and increases bond holdings to maintain balance.
When markets decline, the fund shifts in the opposite direction, purchasing equities at lower prices using bond assets.
This disciplined process forces buying low and selling high, something most individual investors struggle to do consistently due to emotional reactions. By removing emotion from portfolio management, balanced ETFs protect retirees from panic-driven mistakes that often cause permanent financial damage. The returns of these funds are not explosive, but they are steady, predictable, and aligned with retirement income needs. Over long periods, retirees can expect average annual returns in the range of 5 to 7%, with far lower volatility than stock-only portfolios. Most importantly, during major market crashes, these balanced funds tend to decline far less than aggressive investments. Instead of falling 30 or 40%, losses may remain closer to 10 or 15%, making them emotionally manageable. That difference often determines whether retirees stay invested or make destructive decisions during periods of financial stress. The expense ratios on these balanced ETFs are typically very low, often under 0.2% annually. That means retirees receive professional asset allocation and rebalancing services without paying high advisory fees. When compared to traditional advisors charging 1% annually, the long-term savings from using ETFs can reach tens of thousands of dollars. Now let us discuss how these three ETFs work together as a complete retirement strategy rather than individual standalone investments. Most retirees should not rely on only one fund because diversification across strategies reduces overall risk and increases stability. The smartest approach is combining dividend-focused equity, high-quality bonds, and balanced exposure based on personal comfort and income needs. If current income is the primary goal, a higher allocation to dividend and bond ETFs may be appropriate. If modest growth is still desired, the balanced ETF can provide controlled exposure without excessive risk. The key objective is building a portfolio that allows you to sleep well at night, regardless of market headlines. I have seen countless retirees pushed into aggressive portfolios by advisors chasing performance instead of prioritizing client security. When markets fell, those retirees panicked, sold at the bottom, and locked in losses they could never recover. That outcome is heartbreaking and entirely avoidable with a properly structured retirement portfolio. $1 million saved for retirement might seem like a lot, but let's look at how far that actually stretches. You might allocate $300,000 to the dividend ETF, $300,000 to the bond ETF, and $400,000 to the balanced ETF. This structure provides income, stability, and growth potential without relying excessively on any single asset class.
When one part of the portfolio struggles, another often performs better, reducing overall volatility.
This balance creates resilience, which is the most important feature of a successful retirement plan. You are not depending on weapons. That is how financial fortresses are built, not through speculation, but through structure and discipline. Let me explain what typically happens when this protection is missing from a retirement plan. During confidence rises, many believe recent gains will continue indefinitely, ignoring historical patterns and risk realities. Then suddenly, portfolios decline sharply, sometimes losing 30, 40, or even 50% of value. Because retirees need income, this creates a destructive cycle where losses become permanent and recovery becomes impossible. Once assets are sold they remain stuck in cash, watching others recover while struggling to stretch remaining savings. This scenario is the three ETFs discussed work together to prevent this exact outcome. Dividend ETFs continue paying income even when stock. Balanced ETFs automatically adjust allocations to take advantage of volatility without requiring action. Together, market crashes are not rare events. They are recurring features of long-term investing. Anyone retired years, the critical question is whether you will be prepared or become a victim of poor planning. That decision must be made before the next crash, not after it begins. Now let us address the psychological side of retirement investing, which often matters more than math. Many retirees fail not because when working and contributing regularly, market declines feel manageable or even beneficial. In retirement, however, with income-producing and stable assets in place, retirees can avoid selling stocks during downturns. This strategy preserves long-term growth potential while protecting income needs. During the financial crisis, retirees fully invested in stocks suffered severe losses while selling assets to cover expenses. Those with diversified portfolios, when markets recovered, their stock holdings remained intact and fully participated in the rebound. This strategy is not theoretical. It has proven effective across multiple crises. I have seen retirees, sure, the difference always comes down to preparation and emotional discipline. Some people worry that playing it safe means running out of money later in life. This concern is understandable, but often based on misunderstanding. Dividend growth, balanced exposure, and disciplined spending. Additionally, behavior matters more than chasing maximum returns during retirement. Aggressive portfolios combined with panic selling destroy them. Adjustments can always be made from a position of strength when portfolios perform well. The goal is flexibility. Retirement is not about dying with the most money possible. It is about living well without constant fear of financial ruin. A well-structured portfolio restores confidence and freedom. You know income is reliable, assets are protected.
If you have not implemented a strategy like this, action is necessary. Sell overly risky positions and simplify your...
This process takes little time and requires minimal ongoing maintenance. Once established, the system largely runs itself. This is how smart money operates. This is how retirees survive market crashes. This is how you avoid returning to work later in life. And this is how you leave a meaningful legacy behind. Safety, diversification, and cash flow form the foundation. Too many retirees are making avoidable mistakes. Subscribe, stay informed, and take control of your financial future. I believe in direct honesty because preparation changes lives. With the right strategy, retirement can be the best chapter of your life. You earned it.